As we speak, the live market action for SMX, Security Matters PLC on the NASDAQ is showing a sharp intraday decline, with the stock price currently sitting at 13.88 USD, which represents a significant drop of 3.12 or 18.35% during today's session. This kind of volatility is exactly what catches the eye of anyone active in the world of online investing, especially those who are used to the relatively steady climb of something like Apple stock or the explosive but more established growth of Nvidia stock. When you see a double-digit percentage slide in a single day, the immediate instinct is to look for a catastrophic failure, a missed earnings report, or a regulatory hammer coming down. But with SMX, the story is often more layered. While most investors are looking at their screens via a Robinhood app or checking their individual brokerage account at Fidelity and seeing deep red, the reality is that SMX is currently trapped in a tug-of-war between its massive long-term ambitions and the brutal short-term requirements of the public markets. The expectation for this company has always been that its technology, marking physical materials at the molecular level, would eventually become as fundamental as the barcodes we see on every consumer product. Yet the reality hitting the tape today is a stark reminder that even the most ambitious tech needs to prove its commercial durability to keep the lights on and the stock price stable. What's particularly striking about this move to 13.88 USD is that it comes right on the heels of several announcements that were on paper designed to build confidence. Just days ago, the market was reacting to news about SMX being fully financed through the end of the first quarter of 2027. For a small-cap tech player, that kind of runway is usually a green light for investors on SoFi Invest or those using interactive brokers trading platforms to step in and buy the dip. But instead of a rally, we are seeing a sell-off that feels almost detached from the fully funded narrative. This creates a curiosity loop. If the company has the cash to survive for another year and a half, why are people heading for the exits today? The answer might lie in the expectations versus reality dynamic regarding their partnership execution. Earlier this week, the company highlighted its work with True Cotton, aiming to embed molecular identity markers into U.S. cotton for full-chain traceability. People expect these partnerships to translate to immediate, recognizable revenue that you might see in a more traditional investment like a blue-chip company. The reality, however, is that these are often complex, long lead-time industrial deployments. When the market is in a risk-off mood, investors don't want to wait for a 3-year rollout. They want to see the numbers hit the Fidelity brokerage statement next month. If you are managing your own portfolio through self-investing or utilizing an intelligent portfolio service like Schwab Intelligent Portfolios, you're likely seeing this move as a high-risk outlier compared to your diversified Fidelity mutual funds. The sentiment around SMX has been a roller coaster. In late 2025, the stock went on a tear that defied logic, rallying thousands of percentage points as the market suddenly woke up to the concept of giving materials memory. The expectation was that SMX would be the backbone of the circular economy, tracking everything from recycled plastic to conflict-free gold. But as we move deeper into 2026, the reality is setting in that being a tech pioneer is expensive and lonely. The institutional activity we've seen lately suggests a shift in how the big players are viewing the stock. While retail users on the Robinhood stock trading platform might be looking for a quick bounce, institutional desks are likely looking at the conversion of those millions in notes and wondering about the dilution that follows. When those notes convert into ordinary shares, it increases the supply, and if the demand isn't there to meet it, the price naturally sags. That's a fundamental mechanic that no amount of positive press releases can override. Let's look at what this company actually does to understand why the stakes are so high. SMX uses a unique marking system where they hide a chemical marker within the molecular structure of a material, be it steel, plastic, or cotton. This marker acts as a permanent, invisible barcode that stays with the material even after it's been melted down, recycled, or spun into a different product. You can then scan the material with a proprietary reader to verify exactly where it came from. In a world where companies are under massive pressure to prove their sustainability claims, this sounds like a perfect solution. It's why companies like True Cotton are interested. They want to be able to tell a brand that their cotton is 100% U.S. grown, with no possibility of blending with cheaper, unethically sourced fibers. The general belief, the common ground for many investors, is that this technology is a must-have for the future. But here is the contrarian take. Having the best tech doesn't guarantee you a spot in the market. The history of the stock market is littered with companies that had the right answer at the wrong time or couldn't figure out the logistics of scale. SMX is currently in that valley of death where they have to prove that industrial giants are willing to change their entire manufacturing processes to accommodate these markers. Comment below how many shares of SMX you currently hold, or if you're staying away from these micro-cap swings for now. The recent trading volume is also telling a story. When you see an 18% drop on high volume, it usually means someone with a large position decided to move on. If it's on low volume, it might just be a lack of buyers in a thin market. For those using the Fidelity mobile app or checking their Interactive Brokers account, seeing this kind of price action without a specific bad news catalyst can be frustrating. It forces you to look at the macroeconomic pressures. Small-cap tech stocks are the first to get hit when there is any whiff of economic uncertainty. If investors think interest rates are going to stay higher for longer, or if they are worried about global trade friction, they tend to sell the speculative bets and hide out in Nvidia stock or stable Fidelity ETFs. This flight to quality leaves companies like SMX vulnerable. They are essentially being judged by the same standards as a mature company, even though they are still in a growth and deployment phase. The reality of the market is that it doesn't care about your potential if you can't survive the current environment. This brings us to the business model and the older reports. Historically, SMX has struggled with transparency in a way that has made some investors nervous. There have been reports suggesting that despite the high-tech claims, the actual revenue generation has been slow to materialize. This is the ultimate expectation versus reality gap. The expectation is a high-margin, software-like recurring revenue model where every ton of marked material generates a fee. The reality so far has looked more like a series of pilot programs and research engagements. While these are necessary steps, they don't provide the hockey stick growth curve that Robinhood investment users often chase. Furthermore, the company has had to deal with NASDAQ listing compliance issues in the past, including share consolidations to keep the price above the minimum requirement. For an investor doing their own online investing, these are red flags that suggest the company is spending as much time managing its stock price as it is managing its technology. Looking ahead, the outlook for SMX depends entirely on whether they can turn these initiatives into contracts. The Kraken treasury strategy they announced earlier in the year was an attempt to bridge the gap between physical material tracking and the digital world of tokenization. By creating a digital twin of a physical asset, they hope to allow companies to trade verified materials as easily as they trade stocks on an Interactive Brokers platform. It's a bold vision. If it works, it could change how global supply chains operate. But the risk is that it adds another layer of complexity to a business that already has a steep hill to climb. If you were looking for investment help or looking at investing sites for advice, you'll find that SMX is often classified as a speculative moonshot. It's the kind of stock that might sit in a small corner of a Fidelity wealth management portfolio or a Robinhood cash management account as a high-risk, high-reward play rather than a core holding. When you analyze the daily swings, it's clear that SMX is heavily influenced by retail sentiment. Because the market cap is relatively small, a few large orders can move the needle significantly. This is why you see such dramatic intraday movements like the 18.35% drop we're witnessing. For a person using a SoFi trading platform, this volatility can be a tool for day trading, but for a long-term investor, it's a test of conviction. You have to ask yourself if the fundamental reason you liked the company, the molecular marking, has changed because the price is lower. Usually the answer is no, but the price action suggests that the market's patience is wearing thin. Investors are tired of the narrative and they want the proof. They want to see SMX markers in products they can buy on their phone, not just in press releases about future collaborations. The comparison to the big players is inevitable. Think about how Tesla stock was viewed 10 years ago. People thought it was a joke, a niche product that would never scale. The expectation was that traditional car makers would crush them. The reality was that Tesla out-innovated everyone and built a new infrastructure. SMX is trying to do the same for material verification. They want to